Today is Thursday, January 22nd, 2026, and if you attempted to purchase physical silver this morning, you encountered something that should send shockwaves through every precious metals investor watching right now. The dealers didn't tell you the price was elevated. They didn't mention extended delivery times. They simply said no, not inventory is running low, not we're experiencing minor delays. They stated they will not purchase your silver and they will not sell you theirs. This isn't a temporary supply disruption. This isn't a shipping bottleneck. What we're witnessing is a complete shutdown in the circulatory system of the entire United States precious metals distribution network. And the documentation I have here proves this beyond any reasonable doubt. This is an actual trade sheet, not a social media rumor, not speculation from online forums, an official trade sheet from one of the largest wholesale distributors operating in the United States. These companies function as the bridge between the US Mint and your neighborhood coin shop. They are authorized purchasers. They represent the arteries pumping silver through the American economy. And on this sheet under the sell column, every single product displays the same status. Sold out. American Silver Eagles, sold out. Canadian Maples, sold out. 100-ounce bars, sold out. But here's where this situation becomes truly bizarre. On the buy side, the column indicating what they'll pay for your metal, multiple major products are listed as no bid. Let me translate that into crystal clear language. If you walked into this wholesaler today holding 1,000 ounces of silver worth over $95,000 at current spot price, they would refuse the transaction. They would send you away. They don't want your metal. They won't make an offer. They will not participate. The buy button has been completely disabled. Before I explain why this is happening and what it means for silver prices going forward, smash that like button right now, comment below with your thoughts on this crisis, and subscribe because what I'm about to reveal about the wholesale market structure will change everything you thought you knew about precious metals. How is this even possible? Silver just reached $95 per ounce. Retail demand is up 400% year over year. Industrial buyers from Samsung to Tesla are scrambling for supply. The price in Shanghai is trading over $100. According to every fundamental law of economics, wholesalers should be desperately competing for your inventory. They should be bidding $96, $97, $98 just to secure ounces they can immediately flip to the panic buyers forming lines outside their doors. So why are they refusing? Why is the largest distribution pipeline in the US physical market turning away the most valuable scarce asset on the planet? The answer is not lack of demand, it's lack of cash. We are witnessing a liquidity crisis at the wholesale level. These companies are not bankrupt in terms of assets. Technically, they own silver even if they cannot physically access it, but they are broke in terms of dollars. They have exhausted the liquid capital required to fund daily operations. And when a business runs out of cash, it doesn't matter what assets it owns on paper. It can't write checks. It can't pay suppliers. It can't purchase your metal. This is the financial equivalent of cardiac arrest. The blood, the cash, has stopped flowing to vital organs. The wholesaler cannot borrow money. The wholesaler cannot pay you. The transaction dies right there. And when the middleman fails, the entire chain from refinery to your local coin shop freezes completely. But this isn't just happening in America. This is a global contagion, and the data I'm about to share proves that the system isn't bending anymore. It's breaking in real time. Let me show you what's happening on the ground. Not theory, not speculation, but real reports from real people trying to transact in metal right now. A wholesale distributor in the United Kingdom just confirmed the Royal Mint is completely empty. Not low on inventory, inventory, not rationing products empty. The Royal Mint is not some private bullion dealer trying to maximize profits. It is the sovereign issuer of British coinage, backed directly by His Majesty's Treasury. They have first right of refusal on bullion entering the United Kingdom. They are supposed to function as the buyer and seller of last resort, and they have nothing remaining. When a sovereign mint runs dry, that is not a market correction. That is a state-level default in everything but name. If the Royal Mint cannot source silver, what chance does a retail investor have? The vaults have been drained, the metal has been leased, rehypothecated, and sold off until nothing remains but paper promises and empty shelves. Now let's cross the channel to mainland Europe. A dealer in the Netherlands is reporting premiums of $21 over spot. That means with silver at $93 per ounce on the screen, the street price in Amsterdam is $114. That is not a premium to cover minting costs. That is a ransom payment. That is the fee you pay to escape a dying currency. European dealers understand the euro is trapped. They know the ECB has no viable exit strategy. So when they hand you that silver coin, they are accepting fiat paper that loses value by the hour. They are charging you a 22% exit fee just to exchange your fake money for real money. This is exactly what occurred in Weimar Germany. This is exactly what happened in Zimbabwe. This is exactly what happened in Venezuela. The official exchange rate indicates one thing. The street price tells a completely different story. And that spread, that gap, is the real inflation rate. While the West freezes, the East is vacuuming up everything. Singapore, the most efficient bullion market in Asia, is reporting that most shops are sold out. Only pawn shops have scattered inventory remaining. In India, the street price for physical silver just hit $127 per ounce. That is a $34 premium over the New York spot price. That is a 36% arbitrage. Think about what that means. If you are a Swiss refiner with a pallet of silver bars and you receive 2 phone calls, one from a New York bank offering $93 and one from a Mumbai dealer offering $127, who do you sell to? You sell to India every single time. Capitalism flows to the highest bidder, and right now, Eastern markets are bidding up the price to secure the asset while Western banks are desperately suppressing the price to protect their short positions. This is critical information, so hit that like button, drop a comment telling me if you're seeing similar issues in your area, and subscribe because I'm about to explain the fatal flaw in the wholesale business model that caused this entire collapse. The result is inevitable. The metal bypasses COMEX. It flies over London. It avoids US dealers entirely. It lands in the hands of Indian families, Chinese institutions, and Middle Eastern sovereign funds who understand that paper currency is ash and silver is generational wealth. But here's the piece of evidence that should end all debate. Australia is a mining superpower. They extract silver from the ground. They refine it. They mint it. They should have infinite supply. But a dealer in Queensland is reporting delivery delays of 5 weeks. If you live next to the mine in the country where the metal is extracted from the earth and you have to wait 35 days for delivery, the supply chain has collapsed. This is not a logistics problem. This is resource nationalism in stealth mode. The Australian silver is already spoken for before it even emerges from the ground. It is being shipped to solar factories in China, EV plants in South Korea, and defense contractors in the United States. The retail investor is being cut off. You're not banned from purchasing. You're simply made to wait until there's nothing left. Now, let me explain how this happened. How did silver dealers, the people who sell silver for a living, go bankrupt When silver went from $25 to $95, it sounds impossible. It sounds like a paradox, but the answer reveals the fatal flaw in the modern bullion industry. You have to understand that a wholesale dealer is not an investor. They are not a stacker. They do not purchase silver because they believe in sound money. They are a logistics company. Their business model is simple. Buy metal at spot plus $1. Sell it at spot plus $2. Keep the spread. They don't care if silver is $10 or $100. They just want to move volume. But there's a problem. Between the time they purchase the metal from the refiner and the time they sell it to the coin shop, the price might drop. If they acquire 1 million ounces at $50 and the price crashes to 40 before they sell it, they lose $10 million. That would wipe out their entire year's profit. So the banks that lend the money force them to hedge. They force the dealer to short the exact amount of physical silver they own on the COMEX futures market. This is called being delta neutral. On paper, it looks perfect. If the price drops, their physical inventory loses value, but their short position gains. The two cancel each other out. They are protected. But what happens when the price doesn't drop? What happens when silver goes vertical? When silver rocketed from 25 to 95, the value of the physical inventory sitting in their warehouse skyrocketed. They are sitting on a fortune, but their short position on COMEX exploded in their face. For every dollar the physical metal gained, the paper short lost $1. Now you might say, so what? It's a wash. In the long run, yes. But in financial markets, you don't survive to the long run if you run out of cash in the short run. This brings us to the margin call. The gain on the physical silver is unrealized. It's just a number on a spreadsheet. The dealer cannot access that money until they actually sell the metal. But the loss on the paper short is realized every single day. COMEX does not wait. Every night at market close, the exchange calculates the loss and demands cash. Immediate liquid cash. This is called variation margin. As silver rocketed from 50 to 95, these wholesalers were getting hit with margin calls worth hundreds of millions of dollars. They had to wire cash to the exchange every morning just to keep their hedge open. Where does that cash come from? It comes from their operating capital. It comes from the money they use to pay employees, to pay for shipping, and most importantly, to purchase new inventory. They are asset rich, but cash poor. They are sitting on a mountain of valuable silver, but all their liquidity is being drained by the vampire of the futures market. This is the liquidity trap. As the price went higher, the margin calls got bigger. Eventually, they drained their bank accounts, then they drained their credit lines. Finally, they hit the wall. This explains the no bid status. Why can't they purchase your silver? Because every available dollar they have is being sent to the CME group to pay for a short position that was supposed to protect them. They hedge themselves into insolvency. The irony is staggering. The entire US wholesale precious metals industry is being consumed by the very asset they sell. They tied their fate to the fiat dollar. By shorting the metal, they were effectively betting against silver. They bet that the dollar would remain stable. They bet that silver would behave like a normal commodity. But silver is not behaving like a commodity. It is behaving like a currency that is revaluing. And when a currency revalues, anyone who is short, that currency gets wiped out. But the destructive hedge was only the wound. The credit freeze is the refusal to treat the patient. Modern wholesalers don't operate on their own cash. They operate on revolving credit lines provided by major commercial banks. For decades, these credit lines were the oil that kept the engine running. A wholesaler would borrow $50 million from a bank to purchase silver from the mint, sell the silver, pay back the loan, and keep the profit. But on January 22nd, the banks turned off the tap. We are receiving reports that major lenders to the bullion industry are not only refusing to extend new credit, they're actively calling in existing lines. Why? Because to a bank risk officer, silver going to 95 is not a sign of value. It is a sign of volatility, and banks hate volatility. This is where things get really interesting. So smash that like button, comment your predictions below, and subscribe because I'm about to explain what happens next and why a peer-to-peer market is already forming. When an asset draws a vertical line on a chart, the bank's risk model labels it a bubble. It labels it toxic. The bank looks at the wholesaler's inventory, which is now worth 4 times what it was a year ago, and they get nervous. They worry that if the price crashes tomorrow, the collateral backing the loan will evaporate. So they increase the haircut. A haircut is the percentage of the asset's value that the bank discounts for safety. When silver was $20 and stable, the bank might lend 90% of the value. Now that silver is 95 and volatile, the bank might only lend 50%. This creates a collateral crunch. Even though the dealer's inventory is worth more, they can borrow less against it. But there is an even simpler mathematical reason for the freeze. Let's say a wholesaler has a fixed credit line of $100 million. When silver was $25 per ounce, that $100 million could finance 4 million ounces of inventory. But today, with silver at 95, that same 100 million can only finance roughly 1 million ounces. The capacity of the wholesale industry has shrunk by 75% just because of the price increase. This means the wholesaler can only do 1/4 of the business they used to do. They can only purchase 1/4 of the metal. They can only serve 1/4 of the customers. And because they are already maxed out paying margin calls to COMEX, they have zero room to maneuver. This is why they are no bid. It's not that they don't want your silver, it's that they physically cannot write the check because the bank computer says limit reached. This credit freeze is the contagion that eliminates the local coin shop. Think about your local dealer. He operates on cash flow. He purchases silver from the public and flips it to the big wholesalers to lock in a profit. He relies on the wholesaler to be the buyer of last resort. If the wholesaler says no bid, the local coin shop is trapped. He purchases silver from you, but he has nowhere to sell it to replenish his cash. He is stuck holding the bag. Very quickly, the local dealer runs out of cash. And when he runs out of cash, he goes no bid too. This is how the freeze spreads. It starts at the bullion bank, moves to the wholesaler, and ends at the storefront in your town. We are witnessing a cascading failure of liquidity across the entire ecosystem. The velocity of silver has dropped to zero. And the banks are not coming to the rescue. In fact, they are making it worse. By cutting credit lines, the banks are effectively strangling the physical market to try and save the paper market. They are weaponizing the balance sheet. So where does this leave us? The wholesalers are maxed out. The local dealers are closing. The credit lines are frozen. The premiums are skyrocketing. The centralized market structure has failed. It was built for calm weather. We are in a hurricane. But markets abhor a vacuum. If people want to trade silver and the shops are closed, they will find another way. We are about to witness the birth of a peer-to-peer market, a market that is older than COMEX, older than the dollar, older than the United States itself. We are returning to direct trade. For thousands of years, silver was traded hand to hand, neighbor to neighbor, without intermediaries. You don't trade with a bank. You trade with your mechanic. You trade with the farmer down the road. You trade with the person standing in front of you. In a peer-to-peer market, the price is not set by an algorithm in Chicago. It is set by the two people in the room. And right now, based on reports from private firms and local trading groups, that price is converging on $130 per ounce. This creates a gray market, a market that exists outside the banking system, outside tax reporting thresholds, outside the visibility of regulators. It is a market of pure privacy and pure liquidity. And the wholesale collapse is actually the best thing that could happen to the price of silver in the long run. Why? Because it eliminates the leverage. When a wholesaler purchases silver, they short it on COMEX. That suppresses the price. But when you purchase silver from your neighbor, nobody shorts anything. The metal changes hands. The paper market is completely bypassed. A peer-to-peer market is a one-to-one market. There are no derivatives. There are no rehypothecations. There is just metal and cash. This removes the paperweight that has held silver down for decades. So what is the final verdict on price? We are looking at a permanent bifurcation. The paper price on COMEX could show $100, while the physical market trades at $150. This $50 gap is the trust premium. It is the price you pay to know that your wealth is real. The system has failed. The credit lines are cut. The trade sheets are empty. But if your vault is full, you're watching this crisis from a very different perspective. In a scenario where the structure is under pressure, having an unencumbered asset is the primary objective. Thank you for watching this emergency report. We will continue to track the collapse, the rebuilding, and the rise of the new system. Share this information. The middleman is failing. The metal remains.